Hello, Business 226. Welcome to week 5 and chapter 8 and 9. We're going to talk about risk and return and stock valuation. I hope you found the midterm wasn't terrible. I hope you were able to get it done, and I hope you all did really good. Chapter 8, Risk Returns Overview. We're going to talk about standalone risk, portfolio risk, risk and return, actually a lot of formulas, not just a couple formulas. But we're going to look at risk overall, and then we're going to dive into chapter 9, stocks. So what is investment risk? There's two types of risk: standalone risk and portfolio risk. Investment risk is related to the probability of earning a lower negative actual return. The greater the chance of lower than expected or negative returns, the riskier the investment. So if you think you're going to make 10%, but you can make zero or negative versus 20%, that's a risky investment versus if you have a T-bill and you know you're going to get 3% a year. So probability distributions, a listing of all possible outcomes and the probability of each occurrence. So you can see we have this one looks like a lot of different options. This one has much narrower choice of options. Here, selected realized returns, 1926 to 2019, almost 100 years. Small cap 16.3, large cap 12, and you can see their standard deviation. The higher the standard deviation, the less likely you're going to hit that number. So 31% standard deviation, you are all over the map. You are less likely to get to 16.3 versus treasury bills, this 3.1% standard deviation, you are probably right around 3.4% over that time frame. So here, this is going to one of those case studies. Remember, you can pull that down from Canvas online and follow along with it. Here, hypothetical investment alternatives. So here we're looking at what the economy is going to do, the probability of each item, and then different investment options: T-bills, high-tech collections, U.S. rubber, market portfolio. And this is market portfolio as a whole with these. Why is the T-bill return independent of the economy? Do T-bills promise a completely risk-free return? Short answer is no, but generally they stay right on track. We looked at that just a moment ago. They're considered a risk-free in the default sense. They're not risk-free, there's always risk, but they are the least riskiest options out there. How did the returns of high-tech and collections behave in relation to the market? High-tech moves with the market. Collections is countercyclical with the economy. So when things are good, collections does bad. When things are bad in the economy, collections does better, which makes sense. They come get your stuff when you don't pay the bills. So calculating the expected return. Expected return is just all the different options and what we think would happen in each one. So the expected return would be 9.9%. And all we were doing is getting basically the average of all that stuff right there. So you go through, you do a bunch of math, you get the expected return of all these different ones, and we can see high tech has the highest expected return, followed by collections at 1.2%. So does that make high tech the best investment, or have we failed to account for risk? We can calculate standard deviation. Standard deviation, variance, the square root of variance. That looks complicated. Basically, we're just taking the return minus the expected rate of return to come up with standard deviation. This is standard deviation for the different ones. Collections, T-bills, that's what we would expect. And you see T-bills does not have a standard deviation, whereas high tech or the returns, that is a big standard deviation. So are we going to get 9.9? Well, it covers a long range of possible returns, so we probably will not get 9.9 because the standard deviation is higher. Standard deviation measures total or standalone risk. The larger standard deviation, the less likely that you're actually going to get the 9.9. So higher number, you're not going to get that exact return probably. Comparing risk and return, expected return with the risk. See, 3%, no risk, so we would expect to get 3%. Collections in US rubber seem kind of out of wax here. Let's look at those a little bit more. Coefficient of variance, a standardized measure of dispersion about the expected value that shows the risk per unit of return. Standard deviation divided by expected return. And if you illustrate it, you can see that the rates of return change. A is riskier because of a larger probability of losses. In other words, the same amount of risk for smaller returns. And that's not what you want when you want to put your money into something. So here we have the risk ratings by coefficient of variations. And you can see the T-bills, 0, market, high tech, 2.6, and then collections is way out of whack. Why? Because collections works against the economy, right? When an economy is doing bad, collections does good. The Sharpe ratio, another measurement measures standalone risk. It looks at excess return relative to risk. So 9.9 minus the 3 divided by the 20% gives you 0.345. Basically, it's just another way to measure the risk to see how you're doing, if it's worth the investment. Excess return is assets return minus the risk-free rate. Return minus the risk-free rate. Risk is measured as a standard deviation of the asset's return. A risk-free asset will have a Sharpe ratio equal to 0. T-bills equal to 0. Investor attitude towards risk. Risk premium, the difference between the return on a risky asset and a riskless asset, which serves as compensation to hold riskier assets. Remember, we talked about this in chapter 4. If you're more risky for like a bond, we want more money to compensate for that. And so that applies to stocks as well and other sorts of investments. And then risk aversion assumes investors dislike risk and require higher rates of return to encourage them to hold riskier investments. I mean, that's kind of a duh thing, right? If you have a better chance of losing your money, you also want a better chance of making money. Okay, portfolio construction, risk and return. Assume a two-stock portfolio is created with $50,000 invested in both high tech and collections. A portfolio's expected return is a weighted average of the returns of the portfolio's component assets. So if you put 25,000 into each asset, you would expect the ratios to be somewhere in the middle of those, right? Standard deviation is a little more tricky and requires that a new probability distribution of the portfolio returns be constructed. All right, so now we're going to a different formula. Calculating portfolio expected return. Portfolio return is a weighted average of the two investments. That makes sense. So 50% of the 9.9, 50% of the 1.2, so you'd expect 5.5%. So now we have a 5.5% expected return because we averaged all of these probabilities and these returns that we would expect in each one. So 5.5, all of a sudden we went down from 9.9 with high tech down to 5.5 adding in collections. Why would we do that? Well, collections goes against the economy, remember? So when high tech is doing bad, collections will do good. So we're protecting our money a little bit more by having it diversified. Calculating portfolio standard deviation and the Sharpe ratio is the same math, there's just more numbers in it. We come up with the ratios, 0.84, and the Sharpe ratio goes down to 5.43. Comments on portfolio risk measures, 4.6 is much lower than the standard deviation of either of them alone. It's because we're putting them together and we're lowering the risk of losing all of our money because we don't have all our eggs in one basket. It's kind of another duh moment, right? Like that's what we would expect. 35% is normal for an average stock. Most stocks are positive, though not perfectly correlated with the market, and combining stocks in a portfolio generally lowers risk. Another dumb moment, right? The more stocks you have in a portfolio, the less likely you are to lose money because if one goes bad, you still have a bunch of other ones that are going to help out. Creating a portfolio, beginning with one stock and adding randomly selected stocks to a portfolio. As stocks are added, they would not be perfectly correlated with the existing portfolio. Expected return of the portfolio would remain relatively constant. Eventually, the diversification benefits of adding more stocks dissipates after about 40 stocks. And for large stock portfolios, um, it tends to converge around 20%. So once you add a bunch of stocks, at a certain point, you don't lower the risk anymore because you just have the average works out to around 20%. So breaking down sources of risk, standalone risk equals market risk plus diversifiable risk. Market risk, a portion of a security's standalone risk that cannot be eliminated through diversification, measured by beta. Diversifiable risk. That is a hard word for me to say. I'm sorry, guys. Portion of a security's standalone risk that can be eliminated through proper diversification. So you just pull in other stocks from other segments that will lower the risk of one segment of the economy going bad. And market risk is just the market as a whole. We have recessions, we have booms, we have busts. These things happen. If you don't diversify and you hold one stock, would the investor be compensated for the extra risk? No. No, standalone risk is not important to a well-diversified investor. Rational, risk-averse investors are concerned with the making sure that you have a low risk, a low market risk. There can be only one price, the market return for a given security. No compensation should be earned for holding unnecessarily diversifiable risk. So just because you put all your eggs in one basket doesn't mean that you're going to get a huge amount of return. Returns will be capped at a certain point. Capital Asset Pricing Model, CAPM, modeling in risk and required returns. Capital Asset Pricing Model suggests that there's a security market line that states that a risk required return equals the risk-free return plus a risk premium that reflects the stock's risk after diversification. We talked about this with bonds. We have our risk-free amount, which is T-bills, remember, and then we have an amount that we want to earn over that. The relevant riskiness of a stock is its contribution to the riskiness of a well-diversified portfolio. And then beta measures a stock's market risk and shows a stock volatility relative to the market, indicates how risky a stock is if the market is held in a well-diversified portfolio. And so if beta is 1, the security is just as risky as the average stock. If beta is greater than 1, the security is riskier. If beta is less than 1, the security is less risky. Most stocks are around 0.5 to 1.5. So it depends on what you want to do. Do you want to add more risk and look for more return? You can get some of those over 1. If you're looking to lower the risk in it, get one that's below 1. Can the beta of a security be negative? Yeah, it can. If the correlation is negative, the correlation line would slope downward, and the beta would be negative. But it doesn't happen often. Calculating betas. Well-diversified investors are primarily concerned with how a stock is expected to move relative to the market in the future. We don't have a crystal ball. Analysts are forced to rely on historical data. A typical approach to estimate data is to run a regression of the security's past returns against the past returns of the market. The slope of the regression line is defined as the beta coefficient for the security. And here you can see an example of that. See T-bills, nothing there. High tech going up, collections going down. That makes sense because collection works against the market, whereas high tech, it does good with the market. So if we compare those betas, this makes sense. Our expected return during good times on collections is low. The beta is negative. High tech is high. Beta is going up. Makes sense to me. What is market risk premium? Additional return over the risk-free rate needed to compensate investors for assuming an average amount of risk. So we talked about this. This is the risk that you expect to earn over the risk-free rate. Expected versus required returns. Expected, required. So this is undervalued, fairly valued, overvalued, fairly valued. You would buy the undervalued options if that's what you were looking for, and look, undervalued, undervalued. All right. Next is chapter 9. I'll see you guys in just a few minutes.